Hey guys, how you doing? I'm gonna explain the article that I put up from February 4th of this year. It's a very interesting case because it's not always the time when we have the stock market and the bond market going in the same direction. So I think it is just a great time to analyze when this happens, and that will also give you a chance to understand what's the normal behavior between those two markets, okay? So you can see on my screen, this is just the article I put up, and I just highlighted the points that I'm going to talk about. And I hope that gives you a further explanation into what is going on in the market. So as of now, the bond market and the stock market are both going up. The prices of the bonds are going up, and at the same time, the stocks are going up. Now, let's stop for a second and think about this. Usually, bonds and stocks tend to work in opposite ways. Okay, when the economy is growing fast, people tend to risk their money or invest their money in the stock market. So they tend to transfer that money from the bond market to the stock market. So the prices of bonds go down and the stocks go up. When there's a lot of risk and uncertainty in the market, the opposite happens. People tend to go safe with the bonds, so they invest more in bonds and they take that money away from stocks. So you will see prices of bonds going up, whereas prices of stocks going down. Well, in this case, we have both markets going up in prices. So let's see what happens, okay? As far as the bond market, it is this market is related to slower economic growth and little inflationary pressure. So what it means is people think that the economy is not growing as fast and the inflation target is not hitting what the Federal Reserve thinks about it. So if you think about it, if the economy is not growing as fast, then and the inflation is not going as fast either, then rates tend to go down. So prices up again, okay? But stock markets have an interesting view on the economy. They think something is changing as far as how the Federal Reserve is thinking about the market. So let's dive deep into this and let's see what's going on. You have some data there that is really telling you how much the prices of bonds and the prices of stocks are changing. As far as bonds, the yield has dropped as low as 2.55%. And as far as the Standard and Poor's, it has had the largest monthly gain since 2015. So the yields are dropping fast and stocks are going up fast. Okay? All right. So let's start with the bond market first. Let's understand what is happening in the bond market. The economy thinks that the economy is growing, but not as fast as expected. So what that means is that we are not going to have the inflation rates that we thought we were going to have. So when the country or the economy does not have the inflationary expectations met, what happens is the rates are not going up because the Fed won't raise that target rate because it will continue to let the economy grow. So uh, when that thought enters into the investors' mindset, what happens is they tend to push those prices of bonds up because the rates are going to remain low. Okay? So the economy is growing, but not as fast. All right? Now, this has to do with the estimations or projections of how the economy has grown. And every time they revise these forecasts, investors pay close attention to this forecast because that's how they see the rates going. So in the latest estimate, they were down from 2.3% to 2.2%. So what they're saying with the forecast is we're not going to grow as fast. We're still growing, right? We're around the 2.2%, but we're not growing as fast. So we tend to expect inflation to do the same thing. It's not going to grow as fast. Okay? Now, that is as far as the bond market. But in the stock market, something is happening, something interesting, and I think is the most interesting part of that article. First, the stock market is responding positively to the new talks between US and China. So the trade talks are improving quite a bit. So the international market is putting some money, putting some cash flows into the US stock market, and that's pushing the prices up. But more importantly, what's causing the prices of the stocks going up is the change in how the Federal Reserve is looking at the current economy. They are saying that they no longer pretend or tend to increase those rates over the year. And that's important. At the beginning of the year, they said their signal that they were going to do three different increases of rates. Well, now they are saying they're backing off from that plan and saying they might not even increase it once. So what that means is if they're not going to increase those rates, they're not going to try to control the economy. They're going to let it grow. Okay, because remember, the Federal Reserve, when it increases the rates, they are attracting investors to save their money, therefore slowing the economy down. Well, they're not doing that anymore. They're trying to let that flow go, so in order to push the economy, okay, fast. And another interesting point is that the Fed may not continue to reduce its portfolio. What this means is they're not selling their bonds anymore. Okay, they don't want to sell the bonds and have a larger supply, therefore pushing those prices of bonds down. They're not going to do that. They are which is basically the same as we're not going to push the rates up. We're just going to let the economy grow and grow and grow. Okay. Why is this? Well, I think the Federal Reserve is actually looking at the economy as a global economy, not as a local economy anymore. So they are saying we need to grow compared to other countries. We no longer have to control our inflation as tight as back on the 80s and 90s because we are tied to other countries, right? So we might as well let it grow and not push those rates up before time. Finally, the author has a different perspective of it. He believes only on what the bond market is saying. So it says eventually the stocks are going to react to this. Eventually, the stock market is going to realize that the economy is not growing fast and that the stocks will not grow as fast either. So the author at the end is saying that you should believe in what the bond market is telling you, which is the economy is not growing, so we might be safe. We might be better off by being safe with the bond market, right? Because the rates are gonna stay down, therefore the prices of the bonds are gonna continue to go up. Okay? So I think it was important to try to give you an explanation of this very interesting article, and I'm gonna send you a couple questions. So I want to see how you analyze this problem. This is not common. Most of the times they work in opposite ways. When one market goes up, the other one goes down. I'm talking about prices. But we're in an interesting phase of the US economy. I think they're starting to realize that they are more tied with the external world, uh, and they are more dependent on trade talks and how the global economy is going, as opposed as only how the local economy is doing. So I'll follow you with some questions, and thank you for listening to this.